It's the burning question. Is another interest rate hike on the way?
Still thinking about that. I wouldn't say one way or the other yet. I wouldn't like to say more or less likely. We're still analysing the number. We might need to go again.
Melbourne Cup Day interest rate hike. I know those words don't sound very good to most people out there, but I'm just putting out some content, I think, just as a bit of warning. Obviously, I can't read the minds of what's happening down at the RBA, but there are a number of factors which kind of I'd like to discuss, and I want to show you guys a few charts just to show you that don't get complacent. We still might have a bit of pain to go in terms of interest rate rises. And stick around to the end, guys, because I'm going to go over a graph which is a really easy recession indicator. Let's jump into it. Okay, so this is going to look a little bit from left field, but it's a good leading indicator as to what may happen here. And people that follow my content will know that I always start with America a lot. And that's basically because they've got the world's currency. Most of the trading gets done in US dollars. So generally we seem to follow the leader. What's interesting is that the US interest rates have been going up really since early 2021. And what's important to know out of this is actually the US have raised their interest rates a lot higher than ours. To give you an example here, they have fixed rates up to 30 years in America. So I'm just using this as an example. Their fixed rate was down below 2% like ours, the 30-year fixed rate. But if you actually look to now, you can see here that the current fixed rate is actually 7.85. Their interest rates have increased a lot more than ours. Now, what does that actually mean for us, for the Australian economy? Well, if interest rates in America go up further than interest rates in Australia go up, then it means more money gets pulled out of Australia and it goes to America. Why? Because America are offering stronger interest rates. So what you see is when America started raising their 30-year fixed rate in early December, the Australian dollar started dropping. Why? Because, as I said, America are offering better interest rates. So that's been the overall pattern for the last couple of years. Now, the thing is with this scenario is that it creates trade-offs, right? So our resources, which get sold in US dollars, it's better because we're getting more Australian dollars for all of the resources we dig out of the ground. And that's really good for things like government deficits because we tax the miners and then that adds to the country's revenue. Where there's a potential problem with it, the trade-off is that all of the stuff we need to import now goes up in terms of Aussie dollars because things get more expensive. So throw on top of that the fact that fuel's going up, which means it costs more to get stuff over here. We've got things like electronics, for example, that come from most parts of Asia. They're actually going up in value. What does that mean? It's actually inflationary to us. Inflationary just means the cost of stuff keeps going up. So that's a bit of a threat. So obviously when we look at it in Australian terms, the Reserve Bank is just trying to keep prices stable and they want to reduce inflation. So the issue here is that if inflation gets out of hand, then prices will continue to start to soar up again. And if I'm the Reserve Bank governor, I would say, I want to stop that. And how I stop that is I pull the lever again on interest rates. So that's the argument why you'd want to increase interest rates. So let's go to inflation here, guys. We just got a number out today. So updated inflation rates. We can see overall inflation is coming down from this graph, which is a good thing, but it's still at a relatively higher rate. The target inflation, to give you an idea, the long-term target inflation rate for our central banks is around the 2 to 3% mark. So we are still a long way over that. The decrease in inflation isn't as much as what people thought it was going to be. So on the surface, this graph looks good because it's coming down, but it still means prices are increasing. Okay, before I get into my recession indicator, guys, that's basically it for inflation. It's not as rosy as things look. As I've been saying since the start of last year, the only thing that's certain is uncertainty. So just be prepared going in. I'm not saying rates are going to go up. What I'm saying is you need to be prepared for anything to happen and don't find it as a shock if it does happen. Okay guys, here's the easiest recession indicator I'll give you. And again, we go back to the US because we follow the leader. This graph is America's unemployment rate. So that blue line that goes up and down, that is their unemployment rate since 1950. The gray lines are every time a recession has happened. So you can see here, every time we get a recession, the unemployment rate starts ticking up. And that's pretty obvious, guys, because what happens in a recession is people have stopped spending, which means businesses now have to get rid of staff to stay afloat. So therefore the unemployment rate goes up. So you can see out of all of these recessions is that there comes a point where everyone understands we're in trouble. And that's where you get that. You can see there the rates aren't looking too healthy. They start moving up and then all of a sudden the unemployment rate starts increasing at a rapid rate. Interestingly enough, we don't actually know that we're in a recession at that point a lot of the time because the data is backwards looking, meaning we don't know what the data is until the data comes out in the future. Then we know we're in a recession. But it certainly feels like that. So what's interesting is if we zoom into now, we can see here we are still at fairly low levels of unemployment. It's pretty close to what the record lows are, but it is ticking up. So from my point of view, it's going to happen whether we like it or not. Our governments can patch it up and they can give us more money in COVID and make it feel like things aren't so bad, but it's going to happen. When it's going to happen, I don't know, but this is one thing I'm keeping my eye on, as well as inflation, to understand where we're at in the economy. And that's how I position how I'm invested, how I kind of structure my finances. Hope that helps, guys. Give us any comments below, whether they're critical or supportive or whatever. If you've got questions, chuck them in below. I'd be interested to hear what your thoughts are. Cheers.